5 questions to ask before investing your money. Number 1, do you have an emergency savings net? Having a healthy emergency savings net is fundamental to any financial plan. Industry consensus is that you should have at least 3 to 6 months worth of spending in your emergency savings before you even consider starting to invest. 2, how long are you happy to lock your money away for? If you have savings over and above your emergency savings net that you're happy to leave and not touch for 5 years or more, then you might be ready to invest. 3, what's the right platform for you? Investment platforms all charge different fees. Which one is best for you will depend on how much money you have to invest, how frequently you'll be buying and selling investments, and what types of investments you'll be buying. Some offer lower trading fees if you commit to investing a regular amount each month. There are good comparison tools out there, and some platforms have calculators which let you see how much you'll be paying in fees on your portfolio. When you're selecting an account, think about opening an ISA, as that will mean any gains you make are tax-free. You can currently save up to £20,000 a year into an ISA. 4, how involved do you want to be? If you want to start investing, you can either buy a ready-made portfolio, where you decide your risk tolerance and your money goes into a range of investments that suit your risk level without you having to decide anything. Or you can pick your own investments. This gives you more flexibility but involves careful research and decision making. The difference is a bit like getting a ready meal from a supermarket or choosing ingredients to cook for yourself. There's no right or wrong answer, it's just your personal preference. 5, what's your risk tolerance? Whichever option you choose, you need to decide your risk tolerance. If you go for a ready-made portfolio, your risk tolerance will be used to define what balance of investments you hold. If you want to choose your own investments, your risk tolerance should help define what kind of portfolio you build. Most investors hold stocks, bonds, or a mix of both. People with a lower risk tolerance will often invest mostly in bonds. This is basically an IOU where you agree to loan your money to either a company or government. Those with a higher risk tolerance are likely to be investing mostly in stocks and shares. These are stakes in individual companies. If the value of the company grows, then the value of your shares should grow. But company share prices can be volatile, so this is not for the faint-hearted. The more common way for people to access stock markets is via a fund. Funds are investment vehicles which pool people's money and put it into a range of investments for you. You can buy equity funds, which invest in a range of companies' shares, or you can buy bond funds, which invest in a selection of bonds. Investing in a fund should help to reduce your risk, as you're less exposed if one investment goes badly. It's worth remembering that if you go for a fund, there'll be fees charged on top of the fees you're already paying to your investment platform, so make sure to check what they are. This is not financial advice. If you want financial advice, speak to a financial advisor.